Before we get started, I just want to remind everyone that this information discussed today is not intended to be or construed as investment advice. Please consult a professional advisor before putting a loonie in any of these financial markets.
The dirty secret is that no one's ever going to get paid back.
People have the shortest memories when it comes to investment.
We just got to get Keith into Bitcoin.
Hey, there's a bubble. Welcome back to Loonie Hour, episode 90. As always, joined by the three amigos. We've got Keith Dicker of IceCap Asset Management and Rich Diaz at Acorn Macro Consulting. Welcome back to the show, gentlemen. Keith, you got the Snow Globe, the new mic.
Yeah, I know. My other microphone broke when I was traveling. So I don't know what this. Rich said this one looks like the one of the robots in Star Wars. Is that what you called it? A robot?
No, it looks like the eye from the trash can monster in episode 5, Empire Strikes Back. Remember? No, it was the first one. It was A New Hope. Anyways, it looks like the eye from the trash can monster. Come on, Pete. Come on. Really? You guys have never seen Star Wars?
Not a big Star Wars guy. Nerd.
Okay.
I'm more of a Star Trek guy.
Oh, but no, this is terrible call. Anyways, that's what it looks like. The eye from that monster.
It's an intellectual conversation. Oh, speaking of which, I had an intellectual moment yesterday morning. So, I think you guys know, I live near a couple universities. I go to one to get a coffee in the morning. And when you're on campus, you expect to have these, deep philosophical thoughts, innovation, creativity is flowing and all that stuff. It just feels, I love campus. So I'm walking through yesterday morning with my coffee, and I see this guy standing there a bit confused in this sort of smallish parking lot. And I said, good morning. I said, good morning to everyone. And he said, I need your help. I'm like, yeah, what's wrong? He said, I can't find my car. So I looked at him. I said, dude, where's my car? And he didn't laugh, of course.
He didn't get it, eh?
A bit younger.
Grown.
Anyway, this guy is visiting for he's coaching a touch football tournament here down for his team. They're down from Quebec. And I said, what happened? He said, well, I came yesterday. I parked my car and we went out last night and now I can't find my car. I don't remember where he parked this. So we go through all the scenarios. I walk around with him for a bit. And finally I said, are you sure it was St. Mary's University? And he said, this is St. Mary's? I said, yeah. He said, oh, I think it's at the other university. I said, Dalhousie. He said, yeah, that's the one. I said, 10 blocks that way.
Oh, man.
Yeah.
Did you get the lemon loaf?
Mrs. Icecap said I had to knock off the lemon loaves for a while.
Uh-oh. Straight to the hips.
Yeah, that happens. Rich, what's new, man?
Oh man, I don't have a story that can even come close to that. Nothing's new. Just enjoying having my intellectual property ripped off by people on Twitter and trying very hard not to be petty about that.
He's been talking about it all week.
So it's best we just move along, and I don't say anything that I'll regret. But if you do take someone's chart on Twitter, the nice thing to do is give them a shout out, is all I would say. Anyway, let's carry on.
It's the best. This is the best week, though. This is my favorite week of the year.
Is it?
July 1, Canada Day. But most importantly, free agent frenzy.
That's right. Oh, and the Montreal Canadiens picked the right shot defenseman, which was the most boring pick ever. We should have picked the Russian Mishkov. I'm pretty pissed off about that too. I'm all riled up today.
And the Avalanche fleeced your Canadiens trading Alex Newhook there too.
No, I was reading an article about this, and if you pick in the 30s, I think you have a 1 in 3 chance of even making the NHL, let alone becoming a star. So I don't know. Anyways,
that's looking forward to that. I'll be slugging back some beers on July 1st, like a good Canadian boy. But what else has got going on, Keith? We got a huge announcement today before we get into this week's show. So everyone's been asking with the live event, July 27th in Vancouver at the Hollywood Theater in Kitsilano. And there'll be a 300 seat venue, drinks, appetizers, live podcast, Q&A. Come ask us whatever you want, shake some hands, kiss some babies. It's going to be a great time. July 27th. The tickets, if you're listening to this episode, the tickets are officially available on our Eventbrite page. There should be a link in the show notes here. So, like I said, click the link. I think we sold out Toronto last year in seven days or something like that. So
7 minutes.
Trying to set a new record for this one. It's almost double the capacity, 300 seats. But like I said, tickets are available, $49.99. But really a priceless event. So that's what we got.
I think though, instead of kissing babies, everyone, you have an opportunity to kiss Rich. He's in that market. No.
You have to ask for consent, please, everybody. Very important.
Can you just picture everyone rushing over to give Rich a kiss?
No, I can't picture that.
Well,
I can. Be good.
So, quite a bit this week on the housing front. We had Canada's CPI inflation, population growth. We had the Fed out, the ECB. It's more ESG stuff, so we can get Rich teed up on that. Speaking of the housing market here, front and center, we're now entering, obviously, again, Canada Day long weekend. We're noticing the housing market slowing down. Not just from a seasonal perspective, but I think there's a little bit more to this as these rate hikes resume and as yields push higher once again. I'm definitely noticing more of a pullback. So I think it's going to be a very quiet summer for those in the real estate sector. And, that'll be interesting because once we, we'll get into it later on in the show, but once you start overlaying, the housing and the housing starts slow down with the population growth, I think it does create sort of an interesting outlook, over the next 5 years. But Keith and I, we were chatting offline here. But part of the reason for this slowdown, is every Canadian that's been buying a house like this year. So again, people that want to transact, it's been the bulk of the transactions this year. It hasn't really been like these investors like it was during the pandemic. It's been people that need to transact. And so everyone has been transacting using like that 3-year fixed mortgage rate. Because basically nobody's wanted to lock in for 5 years, right? Like, well, rates are 5%. That's the highest in like almost 2 decades. Why would I want to lock in that rate for 5 years? So everyone's been like sort of taking the lesser evil, which has been the 3-year. It gives you enough certainty to sort of get through this pain, these higher rates. And your 3-year fixed rate for most of this spring was kind of 4.7, 4.8. And so, it was stomachable. It was obviously high, but people are, okay, 4.8 for the next 3 years. Well, over the last 3 weeks, we've seen those rates. Now your best, your 3-year rate today is about 5.8. So we've seen 100 basis point move in that most popular mortgage product for this year.
Are you getting, you're on the ground, obviously. When do you speak to mortgage brokers, and do they say that people are starting to push back on that? I know that there's sort of that broader level number that we see on the Bloomberg, but are you seeing sort of anecdotal evidence as far as mortgage brokers saying, listen, people are just not interested, or they can't do what they want to do? Or
yeah, I'd say almost every broker that I've talked to is telling me right now that their pipeline for new applications has slowed significantly. And again, I'm not sure how much of that is seasonal as you head into the summer months. It's always how it plays out. And so I think it's a little bit hard to read into, but I do think that my personal opinion is I think like I said, it's going to be a quieter summer. I think it's a combination not only of a seasonal factor, but of 100 basis point move when you factor in that the reality is that home prices for this calendar year have moved higher. In Vancouver, like I said, your typical single family house is up $200,000 to $300,000 this year. And your rate just moved up to 5.8.
So Steve, let's just say, you're in Kitsilano and you're getting a $1 million mortgage. What's the change? And just say you have to renew now, and now it's at, a full 1% higher than you thought it was going to be a month ago or 2 months ago. What is the dollar approximate value increase in a, say, a monthly? I know there's a lot of factors involved with it, but is it like an extra $200, $100?
Okay,
How does it
let's do
affect
the
it?
math. So if you had a $1 million mortgage, and let's say the rate was going to be 4.8% on a 30-year amortization, which is what most people are doing, your monthly mortgage payment is $4,200. And today at 5.8, it's $5,800. So $600 difference.
It's not as high as I would have expected.
16. Wait, no, you said
600.
42. Wait, no, you just said 4,200 and then 5,800.
Oh God, man. Let me do this again.
This is why we did this
5,200.
before.
No, it's 5,200 to 5,800. So it's $600.
Oh, okay. Maybe I just heard that wrong.
It's that
So
snow
an extra
globe getting in the way.
It could
Yeah,
be.
so, but I mean, $600. I mean, again, like, you factor in that rate, at 4.8, let's say, I mean, gosh, it's probably averaged over the last 5 years. It's probably averaged 2.8.
But remember, it's not just one thing, right? It's $600, but it's also the cost of all of your goods and services have gone up, let's say 30% over the last 2 or 3 years. And we know that wage growth in Canada is lagging significantly. I mean, depending obviously what industry you're in, but wage growth has been 2% over those. So, in real terms, which is what matters, consumers are significantly worse off. And we're starting to see it. I mean, and I think we're starting to see it, although consumer confidence weirdly is perking up. But Keith, I mean, do you see it from your clients? Or are people starting to say, hey, can we draw down on some of our savings or some of the money we have sort of parked away with you?
That's
or
a good question.
No, we're not seeing that activity. That's not happening.
You don't let them? You're like Odie? Did you hear about that?
Gates are
Did you hear about that
closed.
big the gates are Odie, by the way, for people who don't know, Odie is an enormous hedge fund out of UK, I believe. And
Oh,
there was
yeah.
something untoward with their CEO and they gated the anyways. But
No,
you're not
it's-
seeing that.
No, we're not seeing it. But at the same time, though, I think everyone is altering their spending patterns, definitely. And pricing is just outrageous on so many things right now. Now, obviously, it's like 3 years into it, but our compensation has increased enough to offset it. So take anything that you're buying at the grocery store. Like, again, it's like it's whap, like that's a big hit. And you see it other ways. If you do, I was just traveling last week, and some places like, okay, that's reasonable, and then you leave, it's like, wow, that's like $80 for 2 burgers. They're just,
Yikes.
yeah, like it's a lot of money. And I don't mean to say that in terms of, oh wow, I eat $80 burgers, but but when you're traveling, that's when you're spending money every day. Like, it's coming out of your savings, of course, and then you realize, wow, like, and then you would say, are you going to travel again? Like, how often can you do this? And I just think right now, I was chatting with a friend earlier today in the business, and we will talk a lot of things now today, but the ECB, the European Central Bank, they hosted an event yesterday. So they invited this is great, guys. So they invited the top 4 central bankers in the world, or the top 3 plus Christine Lagarde, whichever way you want to look at it. So they had, Powell was there, from the Americans. The British guy was there as well.
And Tiff was there, of course, right?
Yeah,
no, he's
Tiff
not one of the
wasn't
top
there.
4. Okay,
he didn't get invited, but the Japanese guy was there, and he had the money quote of the day, which is quite interesting. So to let you know what that was, they're talking about the lag effect of hike rates of rate hikes. So, because Paul was saying, we're starting to see inflation come down, and we think it'll continue to come down because we increased by 500 basis points in a very short time. And because of the lag effect, we expect it to come in now. Then they switched over to the Japanese guy, and they said, well, what do you think about the lag effect? And he said, well, we raised rates by 25 basis points 30 years ago, and we're still waiting for that to kick in.
come on, he didn't say that, did he? Actually say that?
Yeah, he did.
That's
It's
hilarious.
actually quite funny. He was funny. He didn't say a lot because it was a bit of the language barrier, I think. But he said that with a deadpan face, and I said, "Man, you win!" Like everyone watching this live, everyone's tweeting about it, and everyone's saying, "Wow, what a brave quote."
This guy
Anyway,
just throwing out one-liners, eh?
he was really good. Yeah. So
Maybe you should get him on the show.
That'd be awesome.
Yeah, it
What's his
would.
name?
Yeah, we might need to carry the conversation a bit, but it was pretty good. But back to this whole conversation about, everything is linked together here right now. So with rates going up and stuff like that. But and back to a conversation I had earlier, I might be jumping around a bit, but there she goes. So right now in markets, the yield curve is telling us there's a recession coming. Commodity markets are telling us there's a recession coming with oil and nat gas, coming down, quite a bit. And then you have the central bankers. Yesterday, the four main ones, they all said, yeah, we're going to create a recession. That's what we need to happen. And then, you have, then you had on the currency side, we don't see too much in Canada, but the US dollar is just smoking all these Asian currencies. Like in Asia is one of the key exporting regions in the world. But then we have, equity markets are going higher and credit spreads haven't, widened out yet or blown out yet. So, something is going to get reconciled in that, maybe these recessionary data points get completely turned around or we go the other direction. And again, like if we do get a recession, if it's coming up, and people are struggling to pay $5,800 a month, on their Kitsilano mortgage, some guys won't be able to pay the mortgage, and that's what will happen.
I don't think Kitsilano's where you're going to see your first ounce of pain, though. I'm not gonna be blunt. I think it's going to be out in the suburbs somewhere. I look at, because people, to that point, though, people actually do ask, okay, if there's going to be opportunities, like where they're going to be, when should I buy, when the big correction is going to happen. I'm like, listen, West Side detached real estate, predominant owners have owned it for 30 years. A lot of it has no debt. You're competing with global wealth that, again, is maybe not even taking on a mortgage. Where I think you see that pain is in these blue collar working classes where you're on a fixed income, right? Like you're making $65,000 a year and like you might get a raise to 67 or 68. Like there's not a lot of room to move. And that's a lot in those suburban markets where, if your mortgage payment moves up by $800 a month, then you tack on your grocery bill going up another couple $100. Like that's where I think you see the real pain, and then people that are going to be forced to make difficult decisions is in those sort of more fringe markets.
So I have a question about this. So in the UK, this is sort of happening, I think, just a little bit ahead of time, and maybe the UK can act as sort of a proxy for Canadians. Again, just to remind everybody, in the UK, like in Canada, the mortgage rates are tied to the front end of the curve. So 2-year fix, 3-year fix, whatever. And we're seeing obviously huge increase in those interest rates. So that translates to higher mortgage rates. And the government, the Conservative government, is already talking about, there's discussions basically about, enacting protections for mortgage holders, for people, homeowners. Do you think that kind of thing is on the horizon for Canada if it really does get mean, or like the waters do get really choppy, or do you think is it a different legal structure, or?
Well, I'm curious Keith's thoughts, because I know the audience is like, oh, this guy's a realtor, so of course he's saying that. But like my view is like Chrystia Freeland in the federal budget literally wrote she wrote basically legislation that suggested that banks will work to help Canadians through these difficult times in terms of like their variable mortgages and helping them. So we are seeing that on a case by case basis. Banks are going back to clients and saying, okay, technically you're supposed to go through a requalification to refinance, but you've claimed hardship. Okay, don't worry about that. We'll sort of adjust your payments to make it work. At the end of the day, the banks don't really want to own your house. It is their asset. And so I think they are working with Canadians right now. Now, again, my view is, rates are 5.8 today. You have to get up to 6.8, 7.8, God forbid. I definitely think give it time. We're going to see obviously defaults and they're going to escalate. That's simple math. It's a highly indebted household sector. And I think that given the amount of economic activity that is generated off of housing in this country. Like the reality is, we can go through the numbers, is like we immigrate people en masse and we supply them or sell them housing. Like that's
or the dream of housing anyway.
Right. That's basically what it is. I'm not saying that's the right thing to do.
Are there any charts on the population growth floating around out there?
No. As a matter of fact,
really?
I've shared.
It's
a low blow. It's a low blow, Keith.
Yeah, but not to you. It's to the guy that ripped off your chart.
Okay. Anyway.
By the way, everyone is listening. Get him.
Yeah. No, don't do that.
The Looney Hour.
Keith, what are your thoughts? Like, actually, like, I'm genuinely curious, and like, it's like, again, let's just assume that rates are at 5.8 today. Maybe they go to 6.5, and they stay there for the next 3 years, and you get everybody renewing it. That was at 2%. It's now renewing at 6.5. You get all these defaults. How do you? What's your opinion?
Well, the number of scenarios. I mean, first of all, if there is no recession and we just sort of, muddle along here and everything, households adjust, banks will adjust what they're doing, and companies and government spending will adjust. I mean, that will happen. But the concern, I mean, we talk about mortgage rates. Everyone's thinking about the Bank of Canada all the time. The real risk with mortgage rates right now is that we do get a recession. And then that 3, 5 year and longer mortgage rate just skyrockets.
You think that's a possibility for you? Interesting.
Oh, absolutely. Yeah. Because even though the yield curve might stay inverted, for the government, but the spread that the banks are going to want to lend at is going to widen. Because if you're the Bank of Rich or the Bank of Steve, and you were sitting there and all of a sudden a recession is coming, and you guys would see it before anyone else because you're living it day to day. You see all the money flowing through the system, and then I walk along and say, hey, I want a mortgage, say $500,000. And they look at what my job is, I'm a podcaster, so I don't make much money. And, but you guys are going to say, well, okay, we'll lend it to this guy, but it's no longer at that 5%. It's now up to 7.5%. So you can get a period where, again, we're not there yet, okay? But the probability of it happening, I think it's a lot higher than what people are expecting. So, and this is going to reverberate in so many places. So I'm just getting started. And but so just say, you don't lose your job, you're still doing okay, and your mortgage renewal comes up because say you refinanced in 2020 or 21 or 22, whatever it was, and all of a sudden, that the rate that's being offered to you is say 6.5 or 7%. I mean, and you're able to pay it, but then that's less money you have available then for other spending. Do you know what I mean? So that's the environment, Steve, that as an investment manager that we're really focused on, because then you get all these other knock-on effects from it happening. So
well, yeah, I mean,
incredibly interesting. Yeah, I'm just getting people to refocus. Don't always watch the central banks because, they're important, of course, and, they're the fun to listen to sometimes. But it's really these like 3, 5. I know, Steve, you're really pointing out, I think, the 2, 3, and 5 year all the time, which is where you need to focus on. And that has potential to explode.
Yeah, I'm curious. I mean, like, obviously, just for the listeners, I know you're assigning like a probability to it. But, typically, again, in recessions, if you've got your 5-year bond yield, typically recession, that bond yield's going to fall. Thus, typically, in a normal cycle, you'd see, obviously, lower rates, banks passing that on. But in this circumstance, are you suggesting that the 5-year bond yield would actually push higher, and that's just markets assigning almost like a credit risk to the country?
So not the 5-year bond yield, the 5-year mortgage rate, because you get a spread.
So you're telling me, yeah. So what you're saying is, okay, your 5-year bond yield, whatever it is today, 3.7 or something, it comes back down, let's say 100 plus basis points. But mortgage rates, stay at the same levels or potentially even go higher.
Yeah, absolutely. Because remember, Canadian banks as well, the amount of, loan loss, provision for loan losses or credit losses, whatever they want to call it these days, that's really low relative to the size of their loan books. So banks don't like to lose money. They're not in the business of losing money. They are in the business of understanding that that's their business. So they are going to lose some money. I'm starting to sound like Rumfield, right? From years ago with the Iraq stupid comment. So they don't mind small losses. That's what they will account for. But as soon as they can see a cycle starting to begin, well, they're way behind the curve, that they will batten down the hatches. And one thing that they will be very careful of how much they're lending and then who they're lending. Because even though they're lending out new money, which they might be comfortable with that, their current book, they might have a lot of like dead money on the books there. And so it's like if you're a commercial bank right now, you're worried about it. You have to be worried.
But that has to be a pretty severe scenario. I mean, like that didn't happen here in 08, 09 in Canada. I mean, obviously it happened in most parts.
No, it didn't. Sorry, I'm interjecting here, but that's important. That's a really good distinction. Number one, you didn't have the valuations weren't as crazy as they are now, and the debt to GDP ratios were not as crazy as they were now. And I would argue that the banks were probably better capitalized than they were now, and the exposures and et cetera, et cetera. The other thing is like, but then the other thing is like the not only, even if mortgage rates, let's say just for argument's sake, come down slightly, it's not clear that the banks, as Keith points out, they don't want to lose money. Those lending conditions might ratchet higher. So even though, let's say the mortgage rate come down, I mean, maybe you'll correct me if I'm wrong, Steve, but those banks they'll reduce their aggregate loan book from the top. They'll say, okay, we'll only expand by 5% instead of 15 or 20%. And you can see the credit growth in the whole space is coming way down. I mean, you've talked about this before, where the mortgage lending is, down to its lowest level in however many years. I mean, that's just that's true just of the entire mortgage book, full stop. So it might not be that's the problem with a lot of these issues, is that pro-cyclical. As things get worse, banks don't move to alleviate the pain. They actually exacerbate the pain with tighter credit conditions and higher mortgage spreads.
Well, I can tell you the spreads are definitely padded right now. And we kind of saw that in the most recent, we've seen it all this year, right? Which is like at one point bond yields had fallen quite precipitously. And most major banks were actually very, very slow and reluctant to reduce mortgage rates. We saw TD, one bank, basically sort of lead the charge. And now, as we've seen bond yields push higher, the banks have been very, very aggressive to adjust mortgage rates very, very quickly. So they were very, very slow to reduce their mortgage rates on the way down as bond yields fell. But as soon as they pushed higher, the banks were almost immediately raising their fixed rate mortgage costs.
Yeah. So they're playing with the spread.
Yeah. So, yeah, I mean, it's interesting.
Can I ask a question? Just a really quick one. In the US, you have something called a recourse mortgage and a non-recourse mortgage, and some states you have a non-recourse loan or mortgage and you can like just drop the keys off in the mailbox. I read loads and loads of stories about this in 2008, 9, 10, 11, and people like in Las Vegas, they'd own, it was a gully, whatever. But anyway, so they couldn't afford mortgage payments. And they just drop the keys in the mailbox. Is that a thing? And not all states are the same in the United States. 50 states,
it's all recourse. I think other than like Alberta, maybe.
So again, not investment advice. I don't want people to just drop the keys in their mailbox and run away. I was just curious. Sorry.
No, it is all recourse. But to that point,
can you explain what that means?
What's that?
Can you explain what that means? Just what
it basically means they can come after you for, you can't just leave your keys. They can come after you if, they go take your car or whatever they need to do.
Okay.
So, but I think there was actually a good study in the US that actually showed the largest home value declines was actually in full recourse states.
Okay.
So non-recourse states, yes, they had corrections, but I think it was actually, if you look at the data, it was full recourse states that actually had sharper price decline.
Interesting.
Which is kind of cool. Flies in the face of what you would imagine.
Yeah, that's counterintuitive for sure.
Counterintuitive.
I mean, the other thing that I think we all need to think about, besides the the pandemic, Canada hasn't really experienced recession now for a long time. So I don't think people will know when it eventually happens, because it will. We don't live in this, horizontal fantasy land. But I think a lot of people, the reaction to it is going to be their first initial experience with a true recession. because you got to go back a long time in Canada to really say, oh, wow, we just experienced this. This is difficult. I know 2015 was really hard for Alberta, Saskatchewan, and Newfoundland with oil coming down. But as a broad perspective on the national level, we haven't had that before. And, for all the bankers out there, like, have they really gone through a real, credit challenge yet? Obviously, the pandemic produced one, but the government bailed them out. So again, I keep going back to when we do get this recession, it's going to create a lot of uncomfortable experiences for a lot of people in the credit world, for households, you name it. Like we're going down that path, and no one's ready for it. No one is ready for this. It doesn't mean it has to happen, but boy, if it does, it's going to be a interesting Loonie Hour week.
So there's a good research note here from BMO, and they just dropped this a couple days ago. So it's showing sort of the renewal wall as we speak. Like obviously the pandemic was record home sales across the country, record low mortgage rates. I think you could have got a 5-year fix at 1.3 at one point. There was insured mortgages through CMHC. HSBC had the 0.99% 5-year fixed on an insured mortgage. So imagine people that are having to renew. Again, there's a lot that can happen between now and 2025, 2026, but that's kind of your big renewal wall. So per BMO, this is what they've got. So based on the big six banks here, they've got in 2023, they've got about $276 billion of mortgages coming up for renewal, $276 billion. 2024 is $331 billion. And 2025 is the big one, $352 billion. So 2024 and 2025.
Sorry, did you say 352 billion?
$352 billion of mortgage renewals of balance on coming up for renewal in 2025. And then in 2026, it drops back down to 230. So 331,
That's
352 in 2024 and 2025. So
it's like 15% of GDP if I'm just doing my math really quickly at the top of my head. So if I get this wrong, but Canada's GDP is okay. So yeah,
it's around 12%, maybe.
Yeah, sorry, 12%. That's a lot, man. Holy crow!
I've had no calculator. I just did it in my head.
Well, you were born in 1962, so you guys used to do math. We used calc.
Yeah.
But one thing on the GDP and the recession thing, and I think it's important to put this into context. I think, and not to belabor this point, boys, sorry, but like this is where the
chart. You're going back to the chart again.
I am going back to the chart. This is where population growth is so fascinating and why it fights all of these. Like, it's really, really tough to have a quote unquote recession, which is 2 quarters of negative growth with some kind of employment loss when you just pack in everybody with a pulse into your country, right? GDP population growth rose to 3.14, whatever it is, year on year. I think we're going to crack 40 million people if we haven't done so already.
We already did.
Yeah, sorry.
You missed the party, man.
I missed the party, which is
Stats Can was tweeting about it. It was hilarious.
I mean, that's a cool thing for them to tweet about. If I wrote, ran their social media, I would do that. They've tweeted out other dumber things, so I'm happy that they did that. But my point is like, if you have just that much, that much population growth, it's really, really tough to, to get a recession. On the other hand, though, if as Keith's point out, things are synchronized, the global macro is synchronized, that maybe we might be in a situation where if there is a recession globally, that people feel much less confident coming to Canada, despite the fact that, we let in everybody or whatever it is. And so you might have some sort of a double whammy of slower growth and slower population growth with weak productivity growth. Oh boy, that's not a great picture. I'm not trying to freak people out. I just think it's important sort of counterpoint that pop growth is really important.
So who else is aware of this? It's the central bank. So at the ECB, I'm gonna call it a symposium because I'm an intellectual kind of guy these days. So the head of the ECB said this, the head of the Bank of England said this, and the head of the Fed also said this. The BOJ guy was silent. But what they said was that labor markets are very strong in their economies. And as long as the labor market remains very strong, that they're concerned that inflation will not come down. So therefore, they need to continue raising rates. So again, think about that. They're concerned about inflation remaining strong, sluggish, a lot higher than we want. And the reason it's strong is because of the employment markets. So therefore, Steve, the only way to get it down is to have job losses. Yeah.
We got to fire the podcasters.
You need, wait, we're getting paid? No, we're not. But you need, but if you get job losses, then, you get the demand side will come down. So that's, that again, like it's no secret. We are all aware of why it's not why inflation was created, because it was created because of very poor policies during the pandemic. And now
I was told it was, well, we'll get into that later.
We'll get that. Okay. But now the solution to it, of course, you have to decrease or slow down aggregate demand. And that's a fancy way of saying job losses. So when you have, the 3 or the 4 largest central banks in the world telling us that, then the guys can do, wonderful things. Of course, on the other side, fiscal policy around the world, especially here in Canada. So in Canada, we have the population growth, of course. I mean, that's just surging, but you're also getting so much fiscal stimulus coming at the same time. So what's the deficit of the new budget? Was it 40 billion, 45?
Something like that. In the 40s, like I think.
Yep.
Yeah. So I think back in 2012, 13, it was basically balanced, and it was maybe like 1 or 2 billion under and everything. And now it's at that level. So it's, you get one fiscal policy is offsetting monetary policy. And as long as that's going on, we know the fiscal policy will not sort itself out. The balance is not the budget will not balance itself.
How dare you?
How dare you? But so again, central banks are here, and they want a recession, guys.
Well, and then, like I said, it kind of complicates the picture for the Bank of Canada. Some good updated numbers here from Stats Canada. So Canada's population grew by 1.2 million people in the past year as of the second quarter. Again, unbelievable immigration numbers. It's mind blowing. You look at, Alberta, I think was top of the charts there. But they're on track for the fastest population growth since 1914. So they're growing around 4.7% right now in Alberta.
So I have a little wrinkle to this. So, the Canadian Business Survey, which is from the Canadian Federation of Independent Businesses, they release a survey every month. It's a monthly barometer. You're welcome to check on the website. It's pretty cool, actually. It's got loads of great stuff. They talk about what factors are limiting, production. What factors are inputs more expensive or less expensive? Is there too much red tape? Is there not enough red tape? Is taxes too high, too low? Blah, blah, blah. And one of the questions that they ask is the shortage. What are the factors limiting sales or production? And of course, you can answer different ways. There's different stuff. So limited space, shortage of working capital, insufficient demand, blah, blah, blah. And the two items that continuously rank the highest and remains there basically are skilled labor and unskilled or semi-skilled labor. So despite all of this immigration, it doesn't seem to be plugging in the skills gap, which I find kind of fascinating. So I need to do more investigation into that specific thing. But so far, whereas, for example, the shortages of inputs, which is related to supply chain stuff, that has collapsed, right? So at the peak, it was 30% of companies were complaining about this, and now it's only 10%. So just to give you an idea, sort of the range.
So there is, funny enough, there was a new, as if 1.2 million people wasn't enough. There was actually a new announcement from the immigration minister in Canada, where they announced that it's going to be easier. Our new immigration pathways basically coming to Canada. So for tech workers coming to Canada, they can come to Canada with no job offer needed. Digital nomads on a visa can work remotely from Canada for up to 6 months. And then it says US H1B visa holders and their families can work in Canada, no job offer required. So they're basically trying to recruit more, US tech workers and things of that nature. So again, it seems like immigration, they're trying to make it even easier.
I mean, in abstract, that's a good thing, but we know, well, what have we talked about on this podcast many, many times? One, there's not enough housing. Two, it's like unclear that people necessarily feel comfortable in starting new businesses. We've talked about this a lot. Self-employment, the numbers of self-employment in absolute terms have not changed in 10 years. So this is not exactly where people come to, be entrepreneurs, etc. And there's lots of blockages from the oligopolies who, work to stifle these people who come here. So the productivity story is very, very poor. And although I think, in abstract, HB1s or whatever are good, but we'll see. On
the housing front quickly, and we'll wrap this up on the housing stuff. But so just again, if you're a developer, we've talked about new housing starts have fallen to the lowest levels since basically the depths of the pandemic in December of 2020. Because residential construction costs in Canada have soared 51% since the start of the pandemic. So construction costs up 51%, development lending costs, financing costs to finance these projects up 250% over the past 16 months. And so these projects they're no longer feasible, plain and simple. And then you say, well, what is the outlook for housing in the very short to near term over the next 6 to 12 months? Well, as a developer, I'd say it is a pretty murky situation, right? Mortgage rates are back up to basically 6%. The central bankers are telling you that we still need to slow the economy. We still need to get more rate hikes in. And so, these projects are getting shelved. And so all these supply target things are just pure fantasy.
So do you see rents going up? Oh, sorry. Go ahead. Sorry.
Yeah.
Sorry.
I think you made a really good observation on the lack of investment here in Canada, what's taking place. You and Steve are controlling the country here now. How do you reverse that? How do you encourage not only domestic capital, but foreign capital to come in and invest, to be innovative, to start private businesses, not rely on the government and stuff like that? Because that's what we need in Canada.
Taxes.
We need to attract that.
So there's one way that it's not my idea, and I can't remember whose idea it was, but it was to do with the fact that when you're starting, let's say, a tech company, that you get no sort of coverage from IPOs and that kind of stuff. So let's say you start a company, let's say, it's, Richard Co. and you've brought in all these HB1N visa, whatever, and then you come up with this newfangled mousetrap, let's say, new social media app, whatever it is. And then you go to, let's say your company is a success. I mean, these are unicorns, what have you. And then you want to IPO. That whole process I've understood is very, very difficult. And there are nowhere near the same sort of tax incentives or tax shelters that you might have in the US. And so that's who we're really competing, right? So if you're an English language developer and you have this great idea and you want to come and live in Nova Scotia to develop this thing, and you invite a bunch of really brilliant, hardworking people from ITT, which is a brilliant school in India, and they want to come and work there, and they create this beautiful app, it's very, very hard to sort of extract a huge amount of value. And you sort of and when you have, again, a competing interest, just like, down on the other side of the border. And so that's one of the again, that's not, I can't remember who told me that and if I've screwed that up, I apologize to that person, but that was one of the big interesting incentives with respect to starting new businesses. And in general, just there's a lot. And the other way I would say, which is very obvious, is unlocking the natural resources that we have in this country. We have all of the rare earth metals that we need to provide all of the industrial, we have all the rare earth metals that we need in this country to do all the green technology that everybody's obsessed about, but we don't process any of it here. That's a problem. The other thing is refining. So refining capacity in Canada is the same as it was in 1990. We refine 1.6 million barrels of oil a year. Refining is extremely technologically difficult. It takes a lot of PhDs and master's degrees in engineering and chemical engineering to exploit that. Why can't we do that here? Why are we shipping our crude oil to the United States and then getting back the refined product. We could refine loads and loads of products here and export them. So there's like, to me, natural resources number one, and appropriate incentives on IPOing and tech stuff is the other one. I don't know, Steve, if you have a
no, you're way smarter than I. So I don't have a lot to.
I stole that one off somebody else.
I have a simpler view.
Of course.
I know what you mean. You're more bottom up and very specific. And I think it's easy for me to say this, but it's incredibly difficult for it to happen. In general, if you want, again, I'm back to my innovation story. You have to let the private sector innovate, let them be free to do so. So it's less government, lower spending, lower taxes in overall. And if you create that free environment, then the innovation will happen. Capital will follow it. Workers will follow, building and stuff like that. Because, if you think about it now, I know you mentioned frequently that the percentage of our economy here in Canada, coming from the public sector, I think it's second behind the French right now, right? That's
high.
Yeah, it's extraordinarily high. And so countries that have a lower number with that, that's why the US is so good for the private sector. It's a great place to put your money in because you can create something really cool and then, it'll just take off on its own. But the more that government is involved in everything, then the less opportunity there is for the private sector to be involved in anything. That's a nice quote, isn't it? That makes sense.
Well, you and I clearly share the same ideology.
I'm a little less hawkish that way. I think that to me, the natural resource game, Canadians are trying desperately to convince themselves that they're not a natural resource dependent economy, and I think that's wrong.
Crazy. Why are they saying that? I don't. Well, I know why, of course, but it's
just you strip out natural resources and then you kill housing. What's left?
But what I mean is, like, people think of natural resources as like a dirty, sort of unintelligent, like, knuckle dragging occupation, and that's just not true. Rare earth metal, the processing of which is highly technical. The refining oil is a highly, highly technical trade. You can't just roll up there after some silly degree. These are very smart, very committed scientists and engineers. That's how you have, like when people joke about Texas being backwards and whatever, and in many ways, yes, it is. It's also one of the most highly educated states in America, right? So it's just, we need to kind of recalibrate our understanding of what natural resources really means with respect to technology. And that would be my view, but maybe we should move on a bit.
The three C's: crude, cannabis, and condos.
I'll think of 3 R's: refined oil product, something else. I don't know.
Keith, what else do we got going on? What's got your eye in markets other than the BOJ guy?
Well, there was a great paper came out this week from the Fed, and the date it just came out here in June. I don't see the exact date here, but the paper is entitled "End of an Era: The Coming Long-Run Slowdown of Corporate Profit Growth and Stock Returns." And so here's basically the abstract what this guy writes, and it's to give you an overlay on this. People who know me and hear me talking within my firm. I've been talking now for a while that if you go back to the early 60s, long-term rates went from 4 or 5% up to almost 20% in 82. No one is around today that worked during that period. They're all gone, right? They're not around. And then from 82 to 2010, rates went from 20 down to 0%, which is an amazing time to be alive, especially in the bond market. And then we had about 12 years where the central banks, they suppressed rates. They would not let them rise again. So to use zero rates, negative rates, quantitative easing and all that. So now all of a sudden there's 40 years where rates have never gone up. no one has ever worked in an environment where they've gone up, and there's a lot of complacency, reliance upon policy to keep everything in line. Then, in our view, has been, hey, this is like locked and loaded, and it's going to, just coil and go higher. So the reason this paper caught my attention, because this guy he's actually talking about it and writing about it. And he says in this paper, they show the decline in interest rates and corporate tax rates over the past 3 decades account for the majority of the period's exceptional stock market performance. Okay, so 30 years of lower rates and lower taxes contribute to a better stock market performance. Lower interest expenses and corporate tax rates mechanically explain over 40% of the growth in corporate profits from 89 to 2019. Right, so 40% of profits has come from lower taxes and lower rates. Now we're in a period where, do you think anyone's going to start lowering taxes? I mean, 3 of us would. We just said we would, correct? If we're running the country. But there's no country. If you look at Canada, do you think they're going to start cutting taxes? They can't do it. Because if they do it, the budget just immediately blows out. So they can't cut taxes. In which direction are rates going to go? I mean, they got to go higher, right? They can't go lower again, because don't think about the Bank of Canada rate. Think about longer term rates. And so what this guy, he concludes here, in ritual like this, with CFA designation, the decline in risk-free rates alone accounts for all of the expansion in PE multiples. So the boost to profits and valuations from ever declining interest rates and ever declining corporate taxes is unlikely to continue, indicating significantly lower profit growth in the future. And of course, that doesn't mean the stock market has to crash or anything, but it does imply that what's happened over the last 40 years, it's unlikely it's going to look like that again over the next cycle. So whether that's 40 years or 10 years, we don't know. It's going to be different. And when we start to experience this different experience, people won't have a clue what's hitting them. And so the biggest risk to this is really with investors. So anyone listening, if your mom and dad are in this period where they're about to retire and all their savings is being plowed into these balance funds and things like that, the probability of them experiencing a very quick decline in valuation, it's a lot higher than what you would expect. Like it's just set up perfectly, and everything is hanging on a hinge. And you go back to, again, what the central banker said yesterday. This is from Powell. There is a significant probability we get a recession. Right? It's the head of the Fed, saying that. And he also said, I'm going to find it. It was a really good quote. Oh, there's a high risk to still doing too little. That's with regards to rate policy. So again, we go back. We're in this period, Steve, where the policymakers, they're screaming at you. They're saying it's going to be different than what we've had in the past. So when it happens and you're not ready for it, I mean, I don't know who you're going to go crying to. The government, they're not going to be around to help you.
No, I mean, I think you've been incredibly accurate. You've been calling for a hawkish Fed that's just going to keep raising and raising and raising until they crush something. And I think you've been spot on. I think we've all been maybe a bit surprised about how resilient, parts of the economy have been. I am curious to kind of get your opinion on, raising rates to these levels, and we're going to keep raising them. And central banks are telling us they're going to keep going. How much of this do you overlay on like the math of, let's say, the U.S. government debt? Like what are interest rates as a percentage of their overall debt servicing?
So for the Americans, that's different because they have the world's reserve currency.
Right.
So because of that, there's an enormous appetite for treasuries. Everyone needs them, and the pension funds, the banks need them, and so forth. So it's just not the Americans that needs it. It's everyone in the US dollar world. And if you travel around the world, you realize very quickly, oh, wow, yeah, it is a US dollar world with that. So, but in Canada, it would be a different experience. Same thing in Britain, in places like that.
Isn't the US government's interest expenses like the size of their defense spending alone now?
Yeah, but wait a second. You have to common size it. So as a share of GDP, it's 3.5%. So that seems like a lot, and it's up from the 2.5% of the 2010s. But just to give you context, in 1989 it was 5%. So you say, well, and then for example, as a share of government revenue, of government receipts, right now it's 20%, and in the 80s it was. I'm looking at the chart right now. It was 30%.
Right. So I guess my question for you is if receipts, if government tax receipts sort of level off or fall because, hey, the stock market's not doing so great or real estate's down and there's no capital gains taxes coming in, which are obviously a huge component, thus tax receipts fall. Like I'm just playing devil's advocate here.
No, it's a really good counterpoint, and then so I'm ready for that too. But the difference between the United States, let's say, and Canada is the United States in general is a lower taxed jurisdiction. Like the effective, like Canada has one of the highest effective tax rates for households in the OECD. The US is much lower. I mean, just to give you an example, there's like I can rattle off half a dozen states in America that don't even charge state income tax for, what I mean? Let alone, you know what I mean? So in general, the capacity for the US to raise revenue is extremely high. They don't choose to because they never really had to, if that makes sense. And it's politically unpalatable. But it's not the same as, for example, Canada, where we're taxed a lot. Yeah, Keith.
You're trying to.
I think what Rich is trying to say is that, guys, the US, they are screwed longer term. It absolutely is, because it comes back to what I think at all. I do. I think they are, but they're the last ones in line for it to happen too. I think it goes back to your point, Steve. I think you're trying to go to the question. Yeah, the Americans are in trouble. I'd say their interest burden it increases exponentially and all that because of the numbers. It is tough. But what Rich is saying, I understand as well. In that environment, the whole world is experiencing stress. And money will roll into US dollars because of the safety and liquidity and all that. To buy US dollars, you have to buy treasuries. That's just a function of that game. So there certainly is a world where the US will experience a severe financial crisis, but they're the last ones to experience. Canadians are experiencing it before them. Same with the Brits, Europeans, Japan and China and so forth. And it's, it doesn't mean, we go back to, Rich likes to call it the dragging. Was it dragging your knuckles on the ground? Is that what you call
Knuckle
it?
draggers.
Knuckle draggers. Yeah. I don't think that's going to happen, but I think the opportunity is there to have a pretty serious changing on the way that, money, however you want to define it, is going to work around the world. Because the bottom line is there's too much debt. So whether it's government debt, household debt, corporate debt, not as much, but, we just can't service it all. Like this week, the Brookings Institute came out with another great paper, and they calculated that from 2008 to 2016, they're saying China's GDP was at least 1.7% lower, right? And people say, well, okay, what's the big deal with that? Well, the big deal with that, it means that all of a sudden now debt to GDP numbers are a lot higher, because 1.7% on a pretty big, fast-growing economy is incredible.
We compound, yeah.
Yeah, it absolutely does. So when you see what's happening in China today, so the currency is weakening every day. Like they're trying to hold it together. Banks are struggling there. That's why they're making they're lowering rates. Capital buffers for the banks is being relaxed as well. They're trying to do that at the same time, stop money from flowing out. So it is a big challenge we have here. And you're right, Steve. It's just, again, it's our view here at our firm that the dollar, the time to sell the dollar is when everyone is trying to buy it. Like that electronic money stuff, the crypto stuff from a few years ago. I'm being funny, right? But when it hit a euphoria back in, I think it was 22, I think it was. No, 21.
It would have been towards like the summer of 2021, I think.
Yeah, in 21, when you had that euphoria going on, I suspect we'll have that same euphoria for US dollars. And that's at the point when you say, okay, because by that point, all the other currencies and bond markets are already experiencing stress and crisis. So then that's when you want to sell it. And then, you got to manage to put it somewhere different.
Sorry, can I just go back to your Fed paper? Do you mind? Because I just have something that I think will help people think about these. So you talked about how the lowering of taxes and lower of interest rates basically propped up corporate returns, corporate profits. And, in my world as a strategist, we're often think of like these dualities. And the reason I bring this up is because I think it's, for a long time, what we basically had is capital. In my world, you have capital and often labor. And these are often in tension, whether you have, if you don't have enough, so if you lower taxes and you lower interest rates, capital tends to gobble up a lot of those excess returns. And in a world where taxes are not going to fall and interest rates are going to go higher, and again, I remind people of a chart that I'm very proud of, and someone will definitely steal this one from me too, which is the age dependency ratio. So we have a situation where all of the rich people basically are boomers, and all of the young people and millennials and Generation X have a very, very small portion of, let's say, the quote unquote wealth. And the shift, and what we're not right, in my view, what we're about to experience is like sort of a recalibration of capital versus labor. And that's why, for example, we're seeing wage growth come up, and we're seeing persistent supply shortages. And I think that one of the reasons in my view anyways, is that corporations are going to have either smaller margins, lower expected returns, lower profits, is a situation where you do have the pendulum swing back from corporates and capital to labor, and earn wage earners. I think I can already started to see that happening, but the paper that you sort of outlined, Keith, I think is sort of the roadmap, I think, of how we get there. Sorry.
So the author of that is Michael Smolyansky. It's from June of 2023, so it just came out. What you just described, though, Rich, is a classic. You think about a long-term, like 40-year pendulum swinging.
But that's why I thought it was relevant.
We've gone from capitalism into socialism. Yeah, that's why we're.
I mean, I wouldn't couch it like that. I think that there are market forces that my view are. I wouldn't couch it like that. I think that the part of the reason why it's the younger people will have power is just there aren't enough of us. They're like the age dependency ratios. We've talked about sort of a percentage of working population as a percentage to the whole, right? And that number peaked in 1960s and it troughed in 2010, and now it's starting to rise. What that means is there's fewer employees. And again, it's important to remember that all of the cash, not to get the pitchforks ready, but all the cash is stuck with the generations that are either baby boomers or the silent generation. And so they have all the assets and we have all the labor. And what that means is that the price of labor is going to go higher. So that, to me, I think it's market forces that are driving that. It's fair to say that there are definitely some socialistic forces also driving that.
Or so I don't want to. So when they say you'll own nothing and you'll be happy,
I disagree.
I think it means that if you don't own it, somebody else will own it. I know.
What about the robots? The robots are going to replace us all.
Well, so that's a really, really interesting question, and we should definitely keep that in the back of our mind as we go forward. This idea that will automation sort of help or hurt labor as there's like as a fight basically for that pie. I don't know, Steve.
And then we can all be on universal basic income, spending our CBDCs, eating our bugs.
One more. You just mentioned pie. That caught my attention. This is the last point that caught my attention here. So I don't know if you're following what's happening in New York City these days with the pizza.
Pizza pies.
Yeah, so the city just announced it's a new law it's on pizza shops. They're not allowed to use coal-fired ovens anymore.
It's ridiculous.
And if they are using them, they need to put some kind of muffler on the chimney for it. So I'm a big pizza guy. I love it.
Capture your pizza fumes.
It's just so stupid.
Yeah, it's unbelievable. But if people who've been to New York for pizza, I mean, like Lombardi's is like the famous old school New York pizza. And then they had a typical Italian restaurant family. The boys had a fight years ago. So one brother stayed at Lombardi's and the other one went down on Bleecker Street, down the village, and started John's Pizzeria. and they're both outstanding. But like these old shops, and then there's another one, Brooklyn. I think it's Grimaldi's. It's called.
I love that you
And,
know all this.
Yeah, you can do pizza tours in New York, and it's outstanding.
You're like
But-
the original Dave Portnoy.
Well,
I love
I-
his pizza videos.
Me
that he
too.
does.
His pizza
They're
reviews
fun.
are great. There's a similar story, Keith, that I'm not a pizza guy, more of a bagel guy. And years ago, there's two bagel shops called Saint Pieter and Fairmont in Montreal, which are the greatest bagels in the history of everything holy. And they use wood-fired ovens, and they run them 24 hours a day. And that's the best way that you make a bagel. None of this, shitty Loblaw stuff. Anyways, and in their infinite no fun wisdom,
Rich, Loblaws is our sponsor this week, by the way.
sorry. I love Loblaws. Anyway, my point is that the mayor tried to kibosh these wood-fired ovens, and it's just so stupid, right? And thank God the people fought back. The power to the people. We rose up, and they've grandfathered them in. So we still have beautiful bagels in Montreal. And
Keith,
there you go.
Keith, you're really passionate with your pizza. You make pizza for everyone that don't follow you on Twitter. You fire up the pizza, like a homemade pizza every Friday, don't you? I know I'm not talking
Yeah,
about
yeah.
Alessio
Actually,
pizza.
earlier this morning, yesterday, on Wednesdays I'll do my starter, and then Thursday mornings I'll make the dough for Friday night. So yeah,
You make the dough right after you record the Looney Hour, or what?
no, I made dough earlier this morning. So this is Thursday, everyone. So I made the dough on Thursday morning.
So now,
But yeah, we've been doing it for a long time, Steve. It's something we've been doing, like, here as a family, and my kids, since they were like super young, they know what Friday is. It's kind of funny sometimes. Depends on which oven we're using, but one of the regular oven, the smoke detector is very sensitive to any kind of heat change. And as soon as we open it, no matter what we're cooking, it could be anything, but this alarm goes off. And so our kids always joke, "What's that noise?" And our kids always say, "Oh, that means the pizza's ready."
what's your oven powered by? I need to know.
Coal.
It's yeah. I think it's like 60% coal.
That's right. Nova Scotia is 60% coal.
20% oil, and then 20%.
I have another
stuff.
environmental story, if I may, which
feel
is
like- yeah,
something
okay.
we've been really, really quickly, something we've talked a lot, nuclear power. Anyone who knows me knows I'm obsessed with nuclear power. Probably because I just love watching The Simpsons. But anyways, so the Swedish Parliament passed a new energy target. So they're moving away from 100% renewable energy and easing the way for new nuclear power. Sorry, that was a mouthful. And just to give people perspective, like in the 1990s, nuclear power was 50% of Sweden's energy for electricity. And now it fell down to 30%. So that now it's in the 30s. And a similar thing is sort of happening, but we'll see. So in Spain, there's a general election in Spain coming up. I can't remember exactly when, but basically, surprisingly, the fault line is can't remember if it's the Conservatives or whatever. Doesn't matter. One party basically wants to do a total U-turn on nuclear power as far as their phase out, and they're leading the polls. So hopefully they'll win. And the other party, wants to crawl back into a cave and forget about technologies. But it's amazing. And again, they want
to drag their knuckles, right?
That's right. That's right. They hate technology, and just again to give you some context, in 1990, Spain had 35% of Spain's electricity came from nuclear energy, and now it's down to 20. So there you go.
But what the best part of the show is, I think I know Keith's entire Thursday routine. Get up in the morning, make the pizza dough, go get a coffee, lemon loaf at the local university, and then record the Looney Hour. That's like your whole Thursday.
It's an awesome day.
You're
It's
living a
lot of
You're
fun.
living a good life.
Mhm.
You've made it when, eh?
That's right.
Well, I think that's a good place to wrap it up. To all our listeners, happy Canada Day. We greatly appreciate your support. Go out there, go celebrate. And like I said, the tickets to the live event in Vancouver, would love to see everybody. July 27th. It's going to be from 6 p.m. Doors open. and come drink appetizers. I think we're going to do the podcast from like 7:15ish to 8:30 at night, and then again more sort of open bar towards the end afterwards as well, shutting down around 9:30 or so. So tickets there'll be a link in the show notes where you can check out our Eventbrite page, and tickets are available. I think it's $49 a head, and the first drink ticket is included, and appetizers are taken care of as well. So love to see you all. Happy Canada. Thanks for your support, and we'll see you soon.